Hi, my name is Jordan Choate, and I'll be talking to you today about Home Depot and why I think it's the #1 company to invest in. First, we're going to be taking a look at the 5-year average for ROE. We can see that IBM was the leader, with Home Depot coming in last. Even though Home Depot was last, we're going to be discussing some details throughout the presentation as to why I still think they're a company to invest in. This is the 5-year trend for ROE. We can see that IBM and Microsoft have been very inconsistent compared to Home Depot, steadily increasing over the past 5 years. This is a brief breakdown of ROE with each category: tax, interest, operating, total asset turnover, and financial leverage. In the operating margin category, we can see that Microsoft was the leader, and in total asset turnover, Walmart was the leader. Even though Home Depot didn't lead in any category, they had a slight edge in total asset turnover. We're going to be taking a look at the interest and tax. As we can see that Home Depot was at the bottom and very consistent, and in the tax, they were second to last and pretty consistent over the past 5 years. This is total asset turnover, and we're going to be measuring how efficient a company is with its assets. We can see that Walmart was the leader with 2.3 and Home Depot with a 1.8. This is the operating margin, which measures how much a company makes after paying for variable costs per $1 of sales. We can see that Walmart and Home Depot were at the bottom. Walmart had a 5.9 and Home Depot had a 10.38. Lastly, we'll be taking a look at financial leverage. We can see that IBM was far above the rest of the 5 companies with a 6.02, and the average for the total 30 companies was approximately 2, which was true for Home Depot with a 2.28. Now we're going to be taking a look at ROA. This ratio tells us how profitable a company is relative to its total assets, or how efficient management is at generating earnings using its assets. As we can see, Microsoft took a deep plunge in 2011, whereas Home Depot has been steadily increasing over the past 5 years. Now we're going to be taking a look at liquidity ratios. These ratios will be able to tell us which company can pay back its current liabilities with its current assets. As we can see, Microsoft was the leader in the current ratio with a 2.6, compared to McDonald's with a 1.4 and Home Depot with a 1.3. When we move from current to quick, we're going to be taking a look at its inventory. Home Depot had inventory of 1.11 and a quick of 0.33. Now we're going to be moving from quick to cash, which would measure the receivables, and Home Depot at the top had a ratio of 0.108 in receivables, leaving 0.217 in cash. Home Depot compares to Walmart and Exxon with a 0.10 and a 0.14. However, Microsoft was the leader with a 1.9, which could mean that Microsoft has been inefficient with its cash. Now we're going to be taking a look at market value, price to earnings, and price to book. With price to earnings, a high PE usually tells us that investors are expecting higher earnings growth in the future. And if this is true, Home Depot's at the top, which investors expect Home Depot to grow more than the other 5 companies. And when we take a look at price to book, you're comparing market book value. A low price to book could mean that the stock is undervalued or something is fundamentally wrong with the company. When looking at this, Home Depot ranks 3rd out of the 6, with Exxon, Walmart, and Microsoft at the bottom. This is expected price for 1 year. We took the expected earnings per share times the PE to get expected price. Home Depot's expected price is 82.24 compared to McDonald's of 102 and IBM of 230. Microsoft and Walmart were at the low end with 30 and 79. This graph at the bottom shows us who has the highest expected price. As we can see, IBM, then McDonald's, and Home Depot. For this, we'll be looking at the returns for the expected price over 1 year. We're going to take the expected price, subtract the current, and divide by the current, and that gives us our return over 1 year. The companies with the highest return over 1 year were Home Depot and IBM. IBM beat Home Depot out with 13.72 compared to 12.19. Other companies such as McDonald's and Microsoft had a 0.07 and a negative 8%. Now we're going to be taking a look at relative volatility. With this, we can see how much its stock moves relative to the market. We can see that Home Depot and Walmart were the leaders. Walmart beat out Home Depot with a 1.43. Now taking a look at beta, we can view a company's beta, which tells us how a company returns will react to swings in the market. Let's see. Home Depot had a beta of 1.07. This may seem a little high, but other companies such as Bank of America, General Motors, and Alcoa have betas much higher. Again, even though Home Depot's beta is over 1, it all depends on your risk preference as well. Now we can take a look at the efficient frontier from the 6 companies I compared, and we can see that Home Depot and IBM were on the efficient frontier. I didn't pick IBM because their ROE was so high, but it was driven by financial leverage compared to Home Depot, whose ROE was fairly low, but total asset turnover drove its ROE. As we can take a look at the supply chain, the only thing that really stood out was that one of its suppliers, Home Depot, made up 43.6% of its revenue. Lastly is the weighted average cost of capital. As we can see, its capital charge is $25.75.74, and its economic value added is $19.64.54, which then we have its EVA spread of 6.8%. So they're earning 6.8% above and beyond what investors really expect to get. Now we can take a look at the EVA spread for all 5 companies over 5 years. This is Microsoft, who was the leader in 2008, but has been steadily decreasing over the past 5 years, compared to Home Depot at the bottom, steadily increasing upwards. Conclusion. I'd still pick Home Depot even though they're not the leader in any specific category. Their trends have been steadily increasing over the past 5 years. Its total asset turnover was the leader for its ROE. They're able to pay debt and have little in receivables. Its highest PE ratio, which means that out of the 6 companies, investors expect Home Depot to grow the most. It has the second highest volatility, which allows for the second highest return for 1 year. It sits on the efficient frontier, and it has an EVA of 6.87% above